Well, it leads into, and it's a great question. It leads into what the balance sheet really means of the Federal Reserve. Okay. And if you can think about this in the following way, I think it'll bring us to some of the conclusions I've come to. Look, investing is really finding a mismatch between price and value. Okay. That's all investing is. There's mismatches that are about today's price and value. And then there's a future looking mismatch between what the price is today and what we expect it could be down the road, right? I believe that the mismatch between where gold is priced and where it should be valued is vast. I think gold should be $2,400 today. I believe that it will be $5,000 an ounce within the next 4 to 5 years. And I think it's likely going to be $10,000 an ounce within the next decade, before the end of this decade. And the way I can really put a model to that is the thing that I'm most excited about, like the transition moment we're in right now, Patrick. Yeah. So I think if I talk about the balance sheet, it will then lead to the why physical gold is so critical to our future.
So let's do that. And I have a follow-up question, but first let's go ahead and talk about the balance sheet and what physical gold is versus people say, well, I've invested in gold, but it might not be physical gold, it's something else. What is that something else?
Okay. Once you decide where you want to go, I want to go to Mexico, all right? Then I just need to decide the best way to get there. Do I want to walk? Do I want to take a plane? Do I want to take a train, take a bus, drive a car? Physical gold is one way to get where you're going. It's not the only way. I mean, for most people, they're buying an ETF or some paper mining stock. And for me, because I have a different goal, because we're not talking to traders who are looking to make money in the moment. We're looking to people who are trying to preserve and protect and grow their wealth. You know, our business is targeted towards retirees with retirement accounts, as you know. Okay. So we're not looking at, 25-year-old people who have no money and trying to take $1,000 and turn it into 50,000. We're talking to people who have established their nest egg and want to grow it and preserve it the best way. And, I don't know how to determine, how to advise people in the short term, but I'm quite certain physical metals are the best long-term strategy. And we have a tool on our platform that allows people to measure paper assets in gold, paper investments, versus physical, just the spot price of physical metals, and physical has dramatically outperformed the paper assets over time. Yeah. So, if you are someone who is looking down the road 5, 7, 10 years, which frankly, all of us should be. See, we forget that our investing is something for the future. And I think what happens in these times where we see this massive dump of liquidity is we all lose sense and there is no more investing. It's now all just risk on and gambling. And gambling can be fun, especially when the table's hot, but it's risky, right? So physical gold, something tangible that you can hold on to, that you have a perspective on where its value will be down the road and why, to me seems like the best strategy if you're a long-term investor. As you know, I'm putting virtually every investable dollar I have into physical gold. Yeah. Gold staying at these levels for me is just a greater mismatch and a bigger opportunity. And I think I can share with you a brief synopsis as to why I'm so certain about it. It's the thing I'm most excited about talking to people about right now that's changed. Look, let's take a step back before we take a step forward. The Federal Reserve System was designed by J.P. Morgan, okay? J.P. Morgan bailed out the United States in 1894. He then had to bail out the US again in 1907, two major financial collapses. And in the course of bailing out our country, he realized that he didn't want to be the lender of last resort anymore. And he spent nearly a decade secretly planning how the Federal Reserve would work. And the Federal Reserve has a balance sheet. And it was critical for JP Morgan that the balance sheet be the following. For every $100 in circulation, we needed to have a 40% gold backing, okay? And if you think about assets, liabilities, and then equity, for every $100 of assets, we needed $40 of equity, which gave us $60 of liability, okay? Pretty basic stuff. And from that balance sheet, the reason he wanted it to be that way is if there was a financial downturn, if he needed to collect dollars, he wanted to make sure it was real money that wasn't diluted. So the mandate was that a central bank can never become leveraged, okay? Today, we have assets on the balance sheet of $7.6 trillion, okay? We have liabilities of $7.596 trillion, an equity of $40 billion. The leverage ratio on the Federal Reserve isn't 1.5x like the original design, it's now 194x.
Wow.
Which means that for every $100 in circulation, we actually have 52 cents of equity. And here is the balance sheet problem for the Fed. And then I'm going to give you the secret that I think really gold plays into. We know that the Fed is printing $120 billion a month, right? And as the Fed expands the assets, we're also creating a liability because we have to print the money to buy the bonds. And so assets and liabilities are continuing to go higher at the same time. This has occurred over the last, 20 years as we've taken the balance sheet from, what was 500 billion to now 7.6 trillion. Assets and liabilities have continued to increase at the same pace, and our equity has remained flat at around 40 billion, especially over the last 7 years. So as you can see, if the equity stays the same and the assets continue and liabilities continue to expand, well, the leverage ratio is going to continue to grow. And it brings us back to what a balance sheet really is meant to tell us. See, a balance sheet is simply a way to identify the credit worthiness of an entity. You and I, Patrick, as individuals, we have credit scores, right? Yeah. That credit score tells a lender how good a credit risk we are. The better our score, the better the risk. It's not a guarantee that we will make our future payments. It's just a way to determine the risk.
Right.
A balance sheet for a corporation is the same way. Is the corporation over leveraged? And the balance sheet for the Fed indicates the exact same thing. See, is there too much debt or leverage taken on? How at risk is the entity? Well, the entity of the balance sheet for the Fed doesn't represent a shareholder like a stock does. The shareholder in the Fed is anyone who's using the dollar. And so we're all shareholders in the Fed's balance sheet. The dollars we hold are that shareholder value. And ultimately, it's that dollar that's at risk of ongoing devaluation. And as the assets and liabilities continue to grow, if we just print more and more and more money, well, the leverage ratio, which is the simple way that many analysts judge a stock or a bond or individual, we're going to be more and more at risk. And that math is the problem for the Fed. So how do you, it raises a question, right? And the question really is, okay, well, how do we get out of this spiral?
Right.
Because we know, and this was really the conclusion of, the big great devaluation that, went viral, is we know the Fed has to expand the balance sheet. And they're going to continue doing that. In fact, every time Jerome Powell comes on TD, he keeps saying how the economy's not in a place, we're going to keep printing $120 billion a month. So the assets and liabilities are on autopilot. And if you just do the math, 120 billion a month is about 1.5 trillion a year. By the end of 2025, we're going to be $14.5 trillion on the balance sheet. And if the equity continues to stay the same, the leverage ratio is going to go from 194 to like 395. Okay. And that will mean we have 26 cents for every $100 of equity.
So the question is, though, because you said, how do we get out of it? I think the first question is, can you get out of it?
Well, if you look at it from a balance sheet perspective, this is math. Okay. And there's really a couple ways that this works. We need either to bring the liabilities down, okay, which would mean contracting the money supply. It would mean probably, causing markets to collapse in order to bring down our risk, right? Or we can bring the equity side higher, okay? And so how do you, when the assets that are held are 99% bonds, what makes a bond go higher in value? What makes that equity increase?
Interest.
Well, yeah, exactly right. When interest rates, that's exactly right, Patrick. We know that when interest rates go down, bond values go higher. So one way to keep the dollar from getting too far out at risk is to have interest rates that continue to go lower. Well, we have interest rates at zero. The Fed is not likely to go to negative rates. And the reason is, if they put out a negative rate, no one's going to keep their money in the bank anymore. Okay? If the bank charges a negative 2% to keep your money there, your 100,000 is going to be worth 98,000 in a year. You're not going to keep your money in the banking system. And so that's not a tool that they're going to use. So the way that they get there is through devaluing the currency. And it's really where gold fits in, and why I believe you're about to see gold really move dramatically higher from here. So I think these levels are, a fantastic mismatch between price and value.
Thanks so much for being here and watching that video. And can I ask you to please subscribe to our channel so you can find out when we're posting new content. You'll be alerted right away when we do. To share this with people you think might benefit from the information, and certainly it helps us if you like the video. So if you like what you just saw, go ahead and hit that like button. And again, thank you so much for being here with me right now.